In this video, we break down why economist Harry Dent predicts the everything bubble will finally burst in January 2026 and the exact strategy you need to protect your wealth before the 90% drop begins. They told you the worst was over. They told you the soft landing was achieved. They told you that 2025 was the victory lap. But if you look at the calendar, you'll realize we are standing on a ledge. It is December 2025, and according to the man who predicted the Japanese bubble burst in the 80 seconds and the dot-com crash in 2000, the ground is about to vanish. Harry Dent is screaming a warning that nobody on Wall Street wants to hear. He's not calling for a recession. He's not calling for a correction. He is predicting a 90% drop. And the most terrifying part, he says the demographic math points to a specific date when the everything bubble finally pops. That date is weeks away. To understand why January 2026 is the danger zone, you have to look at what we just lived through. Since 2009, we haven't had a real economy. We've had a hallucination. Harry Dent calls this the 17-year super bubble. Think about it. Since the Great Financial Crisis, central banks have printed roughly $27 trillion globally. They didn't fix the debt problem in 2008. They drugged it. They kicked the can down the road. But now, we have run out of road. In 2024 and 2025, we saw the final stage of this mania, the AI boom. Companies like Nvidia and Microsoft held up the entire S&P 500. You felt it, right? The cost of living didn't go down, but the stock market kept going up. That disconnect is what Dent calls the blow-off top. But bubbles don't just hiss and deflate, they burst. And they usually burst when the last bear finally throws in the towel and buys in. That happened 3 months ago. The retail investor is fully invested. And that is exactly when the trap snaps shut. Now, you might be thinking, economists have predicted 50 of the last 2 recessions. Why listen to Dent? Because Dent doesn't look at feelings. He looks at birth rates. His core thesis is simple, terrifying, and historically accurate. Demographics are destiny. Here is the mechanism. Follow me closely. The average human being is a predictable economic unit. You enter the workforce. You spend a little. You get married. You buy a house. You have kids. Your spending peaks exactly when you are 46 to 50 years old. Why? Because your kids are teenagers. They eat everything. They need cars. They need college. You are spending every dime you have. This drives the economy. But what happens after 50? The kids leave. The house is furnished. You stop spending. You start saving for retirement. The economic engine turns off. The millennial generation, the biggest generation in history, has been powering this current boom. But look at the chart. The peak of the millennial spending wave is effectively now. Behind them is Gen Z. A smaller generation. Less money. Fewer kids. Less spending. We are walking off a demographic cliff. In 2026, the number of buyers in the economy naturally drops. No amount of money printing can force a 60-year-old to buy a second family home they don't need. So why January? Why not next summer? Dent points to a phenomenon known as the first 5 days indicator. But more importantly, he points to the lag effect of interest rates. The Federal Reserve raised rates historically fast. We all waited for the crash in 2023. It didn't happen. We waited in 2024. It didn't happen. Why? Because the economy had a buffer of cash left over from the pandemic. That buffer is gone. Delinquencies on credit cards are at 2008 levels right now. The savings rate is negative. The corporate debt wall hits in 2026. Trillions of dollars in corporate loans, taken out when rates were 0, need to be refinanced this year. But now, rates are 5% or 6%. Zombie companies that only survive because of cheap debt, will not survive 2026. Dent predicts a cascade of bankruptcies starting in Q1. When the first domino falls, the algorithms react. And because the market is so over-leveraged, the drop won't be 10%. It will be an air pocket. Let's talk about the number that makes people laugh at Harry Dent. A 90% drop. It sounds absurd. If the Dow is at 45,000, he's talking about it going to 4,500. It sounds like fear-mongering. But is it? In 1929, the market fell 89%. In the 2000 tech crash, the Nasdaq fell 78%. Dent argues that this bubble is worse than 1,929. In 1929, they didn't have 17 years of artificial stimulus. Look at the AI bubble. We have priced in perfection. We are assuming AI will double corporate profits in 2 years. If that doesn't happen, if AI is just a tool and not a god, the valuation compression is brutal. If Nvidia drops 50%, the S&P 500 drops 15%. If the S&P 500 drops 15%, margin calls go out. People are forced to sell. The algorithms sell. Panic sets in. The uncomfortable math is that a reversion to the mean, just going back to normal historical valuations, requires a 60% drop from here. A 90% drop is just an overshoot. And markets always overshoot on the way down. If Dent is right, 2026 will look like a mix of 2008 and the 1930. First, the wealth effect vanishes. Your stock portfolio gets cut in half in 3 months. You stop spending. Then, housing freezes. Dent calls real estate the deadest asset. It doesn't crash fast, it just stops. No buyers, you can't sell, your equity is trapped. Then, deflation. Not inflation, deflation. Prices crash because nobody has money. This is the part that confuses people. We are all terrified of inflation. But Dent says the monster in the closet is deflation. When $100 trillion of asset bubbles evaporate, that is money disappearing from the system. The dollar actually gets stronger because there are fewer dollars chasing goods. So, what do? If you believe even 10% of this prediction, you need an insurance policy. Here is Dent's controversial playbook. And warning, it contradicts almost every gold bug and crypto bro on YouTube. Step 1. Cash is king. In a deflationary crash, cash is the best performing asset. It allows you to buy everything else for pennies on the dollar later. Step 2. The Treasury safe haven. Dent loves long-term U.S. Treasuries. Why? Because when the crash hits, interest rates will plunge to zero. When rates fall, bond prices soar. It's the one thing that goes up when the world burns. Step 3. Dodge the fake havens. This is where he makes enemies. Dent predicts gold will drop initially in the panic. He predicts Bitcoin could revisit $15,000 or $30,000 before it goes to $1 million. He calls it the sale of a lifetime, but only if you have the cash to buy it at the bottom. Harry Dent has been wrong before. He has been early before. Being early is the same thing as being wrong in finance. But here's the question you have to ask yourself tonight. If he is wrong, and you sit in cash for 6 months, you miss out on maybe 5% or 10% of gains. You feel a little silly. But if he is right, and you stay all in blindly hoping for a soft landing, you lose 20 years of wealth in 20 weeks. January 2026 is knocking at the door. Are you going to answer it?